The stock market dropped. Investors panicked. Reddit forums lit up. Financial news anchors pulled out their red graphics and dramatic music. And Warren Buffett? He watched. Quietly. With $397 billion sitting in his pocket. No buying. No bold moves. Just patience. And when someone finally asked him, point blank, why he wasn't deploying all that cash during the 2026 market pullback, his answer was ice cold. 3 times since I've taken over Berkshire, it's gone down more than 50%. This is nothing. Nothing. That's what he called it. Nothing. So today, we're going to answer the one question every investor is asking right now: why is Warren Buffett still sitting on the sidelines? And what does he know that most people don't? Let's break it all down. First, let's talk about the number that shocked the entire financial world. At the end of Q1 2026, Berkshire Hathaway is holding approximately $397 billion in cash and short-term Treasury bills. Let that sink in for a moment. $397 billion. That is more than the entire market capitalization of Bank of America. More than Coca-Cola. More than American Express. We're talking about companies that Buffett himself built his fortune investing in, and Berkshire's cash pile is now larger than all of them. For years, Wall Street was laughing at him. While the S&P 500 was climbing on the back of an AI frenzy and tech euphoria, critics called Buffett's cash strategy timid. Some called it outdated. A few even questioned whether the Oracle of Omaha had simply lost his touch. But here's what happened in 2026. The S&P 500 fell roughly 11% year-to-date. And Berkshire Hathaway? It was up approximately 12% over the same stretch. Suddenly, that mountain of cash that looked like a mistake for 3 years looks like the move of a chess grandmaster. The question is, how did he get here, and why is he still not spending? Buffett didn't stumble into $397 billion accidentally. This was the result of a decade of deliberate, disciplined accumulation. For over 12 consecutive quarters, Berkshire was a net seller of stocks. He quietly trimmed his Apple position, one of his biggest and most profitable investments ever. He reduced Berkshire's stake in Bank of America. He let profits accumulate without recycling them into new bets. Every quarter, the cash pile grew. And every quarter, the financial media asked, why isn't he buying? His answer was always the same. Paraphrasing Buffett's own February 2025 shareholder letter, often, nothing looks compelling. That's not pessimism. That's not fear. That is a disciplined investor refusing to lower his standards just because he has money sitting around. Think about it this way. Imagine you're a chef. A world-class chef. Someone brings you ordinary, everyday ingredients, nothing special. Would you make a 5-star meal with mediocre ingredients just because you have the kitchen and the tools? No. You wait. You wait until the right ingredients arrive. That's Buffett. And right now, according to him, the ingredients are still not right. Now let's go to the statement that made headlines in early 2026. In a CNBC interview, Buffett was asked directly, given that markets had fallen, was this his moment to start buying? His response was extraordinary in its calmness. He said that Berkshire stock itself has dropped more than 50% on 3 separate occasions during his tenure. 3 times. More than half of its value, gone. And Berkshire not only survived those moments, it came back stronger every single time. Compared to those historical crashes, the dot-com bust, the 2008 financial crisis, the COVID collapse, the 2026 dip simply doesn't register. This is a man who has stared into the abyss of genuine market catastrophes. He's seen panic so severe that nobody was answering the phone on Wall Street. He's watched legendary firms collapse overnight. He's bought when blood was in the streets. A 10 to 11% dip? For Buffett, that's a Tuesday. And here is the key insight. Buffett isn't waiting because he's scared. He's waiting because the prices aren't low enough yet. There's a huge difference between those two things. Being fearful means you don't want to buy. Waiting for the right price means you absolutely want to buy, just not yet, and not at these valuations. Something else happened at the May 2026 Berkshire annual meeting that you need to hear. This was Buffett's first annual meeting as Chairman Emeritus. He had passed the CEO role to Greg Abel, and he was sitting in the audience for the first time in 60 years. But Buffett still sat down with CNBC anchor Becky Quick for an exclusive interview during the lunch break. And what he said was one of the most striking market warnings he has ever delivered. He compared today's financial markets to a church with a casino attached. The church, he explained, represents genuine long-term investing, people buying businesses, holding them patiently, letting compounding do its work. The casino? That's the explosion of speculation we're seeing right now. One-day options, zero-day contracts, prediction markets, leveraged bets. Instruments designed not for ownership, but for gambling. And here is his exact position on one-day options: not investing. Not even speculating. Pure gambling. He said, and these are his words, that we've never had people in a more gambling mood than right now. Think about what that means. This is a man who has been investing since the 1940s. He has seen every bull market and every crash for over 75 years. And he is saying that today's speculative fever is the highest he has ever witnessed in his entire life. Meanwhile, the Buffett Indicator, the ratio of total U.S. market capitalization to GDP, was sitting at approximately 225 to 232% at the time of these statements. Buffett himself has said that anything above 200% is, in his words, playing with fire. The market isn't cheap. And Buffett knows it. So what would actually get Buffett to open the vault? He's given us clues over the years, and his 2026 statements sharpen the picture. First, a genuine panic. Not a correction. Not a pullback. A real moment of fear where, as Buffett has historically described it, nobody is answering the phone. He wants to buy when others are being forced to sell, not when they're choosing to take modest profits. Second, he wants price to matter. Berkshire doesn't buy just because something dropped 10 or 15%. It needs to drop to a level where the business's intrinsic value is significantly higher than what you're paying. That gap, between price and value, is where Buffett lives. Third, he's looking for elephant-sized deals. Berkshire is so large now that buying a small company barely moves the needle. He needs transformative acquisitions. And those don't come cheap. They come when fear drives prices to genuinely distressed levels. In his own words from the 2026 annual meeting, "It isn't our ideal environment for deploying cash for Berkshire. Sometimes we do nothing, but other times we get quite active." The message is clear. He has the ammunition. He has the patience. He's just waiting for the right target. Now you might be thinking, okay, but I'm not Berkshire Hathaway. I can't just sit on $397 billion. What does any of this mean for me? Here's the lesson: Buffett's behavior is not about the size of the portfolio. It's about the principle behind the portfolio. Lesson 1: Cash is not a failure. In a world obsessed with being fully invested, holding cash while you wait for real value is a strategy, not a mistake. Lesson 2: Your standards matter more than your FOMO. The market dropping 10% does not automatically make it cheap. Always evaluate price relative to value, not price relative to where it was. Lesson 3: Patience is the real edge. Most retail investors lose money not because they made one bad investment. They lose because they couldn't wait. They bought at the wrong time, panicked at the first dip, and sold at exactly the wrong moment. Buffett's 60-plus-year career is essentially a masterclass in doing nothing until the right moment, and then acting decisively. For Indian investors watching Nifty or Sensex, this principle applies just as directly. When markets are elevated, when valuations are stretched, when retail participation is at euphoric highs, that's precisely when the disciplined investor steps back, not forward. Build your cash. Strengthen your watch list. Wait for your moment. Warren Buffett has sat through 3 50% crashes in his career. He's seen bubbles form and burst across 9 decades of market history. And today, At 95 years old, sitting in that audience in Omaha with $397 billion behind him, his conclusion is simple. This dip? Not big enough. The real opportunity hasn't arrived yet. But when it does, when the casino finally goes quiet and the church empties out, Buffett will be ready. The question is, will you? If this video gave you a new perspective on how the greatest investor in history thinks, please hit like and subscribe to Master Investor Mindsetter. We break down the wisdom of legendary investors so you can apply it to your own financial journey. Drop a comment below. Are you holding cash right now, or are you buying the dip? I'd love to know where you stand. See you in the next one.